Welcome back. Amidst the weakness in the market, a couple of stocks are actually doing well. Let's begin with the top Nifty gainer today, and a top Nifty gainer by a mile. We have Titan, which is up almost 4%, though off highs along with the market, but still sitting with a gain of 4% and there are a couple of reasons for that. The biggest reason, of course, is the way the company's second quarter business has performed. The overall sales grew by about 18%, but the mainstay of the company's business is the jewelry vertical, which grew around 18% on a high base. Same time last year, remember, the jewelry business grew at around 66 odd percent. So if you just take a look at the 2-year compounding growth, it is over 40 odd percent, and that is something that the street likes. Importantly, the gold jewelry, which is plain gold low margin business, clocked in low double-digit growth, which is lower than the overall growth, and studded sales actually grew higher than the overall division. What this did is improve their product mix, and perhaps we will see improved margins on account of that as well. They're still below pre-COVID level, but they're better than same time last year. They have an optimistic outlook for the festive season. Remember, the second quarter had a lean period. There was Shraddh, etc. as well. But now with Navratri and Diwali coming in with the wedding season, the third quarter looks strong, and that is why the company has added 25 jewelry stores, 91 total stores, and the other verticals of the company are now firing as well. Watches grew about 20 odd percent. Eye care optically grew by about 7 odd percent, but remember, the retail sales have been much faster, so there was some element of inventory destocking out there. So going forward, restocking would improve their eye care business as well. Carrot Lane, which is online sales of jewelry, grew by around 56%, and all the other businesses that the company seeded has done well as well, and that explains why the stock is higher.
All right, Mangalam, by the way, we have a news flash that's down for you on the screen. That's the Bloomberg Wires flash. Credit Suisse, they've offered to buy back debt securities up to nearly around $3 billion. So, trying to give a bit of a vote of confidence out there. It's still an evolving situation, but we need to see how that one does play out. But coming back home then, Mangalam, you told us about Titan, sparkling, so to call it, or shining. But Dabur, a bit of a dampener. Stock has been underperforming as well, though the second half of the year could look up, right?
The second half of the year could look up for all the other FMCG stocks as well, because that's what the thesis of FMCG investing in this year has been. But the reason why Dabur is underperforming in today's trading session is because of their update that has come in. 4 to 5% sort of growth, mid-single digits, so to say, as far as their revenue is concerned on a consolidated basis, and that would be led by India business, which is about 70% of their overall business, growing in mid-single digits as well. But internals for Dabur aren't as bad, because on a base of 43%, the foods business has actually grown in double digits. Secondly, on a base of 17%, their home and personal care business as well has grown at around, mid-single digit odd. The reason why the portfolio has been impacted are two. One is their healthcare business saw a muted quarter, perhaps a bit of a decline this time around. That is on account of a high base same time last year because of COVID. 3-year CAGR has been high double digits out there as well. And the second part is, while the international part of the business actually on a constant currency basis did well, the translation losses would be much more because of the depreciation that we've seen in the Turkish as well as the Egyptian currencies. The margins, while they would improve quarter on quarter, there would be a decline by about 150 to 200 basis points year on year, and the management has guided for a strong second half as well. So let's see where we go from here. The stock, of course, was underperforming in the last 5 sessions. Yesterday as well closed at the lower point of trade, and today as we speak opened muted and then has moved to the low point of trade.
Okay, all right, Mangalam. Well, let's hop across to Sonal. She's standing by to tell us about Phoenix Mills. Well, it's trading with a cut of 1.5% or thereabouts. The quarter two consumption, though, at around 130% of pre-COVID. Well, Sonal, those numbers look pretty good, isn't it?
They are. Looks like you're going to the mall and buying a lot of jewelry, Nigel, or maybe Navneet is doing that. But as far as the quarter two numbers for Phoenix Mills are concerned, a strong set actually. 130%, as you mentioned, the consumption in quarter two of FY23, which compares with quarter two of FY20, which is the pre-COVID level. It's a good showing out there. Total consumption, however, on a quarter-on-quarter basis was flat at 2,200 crore rupees, but that number is much better than what was expected. Revenue per available room, it has been increasing over last couple of months. In the month of September, it was at 11,242, which compares with 8,900 just that was seen in July itself. In terms of occupancy as well in their hotels, it has been continuously increasing, averaging around that 86% mark. So good going as far as revenues are concerned, consumption overall, but the stock has come in for some profit taking, but has been doing well in last couple of days.
Well, Sonal, priorities change with time, and that's what's happened with me as well.